Good morning, very warm welcome to everyone. Thank you for coming to our Criteria Masterclass today, brought to you by Mortgage Brain. Really great to see so many of you here. I'm Grace Teager, the product owner for Criteria Brain and Affordability Brain at Mortgage Brain. And it's my great pleasure to welcome you all to our virtual event this morning. Today's masterclass is brought to you by the Family Building Society. We have Nathan Waller and Cami Amira here. Nathan is a business development manager and Cami is the head of strategy and distribution. So thank you very much for them to join us. Nathan and Cami are going to delve into the topic of lending into retirement and how the family can provide solutions for all clients from 18 to age 95, anywhere in between. Both Nathan and Cami will stick around afterwards to answer any questions. So anything you have, pop in the question box and then we can get them back here to answer any questions you have. We will be sending a questionnaire out to you guys later today. It's really important to get your feedback, to hear what you think of these masterclass sessions. So if you could have some time to complete that and send it over to us, that would be brilliant. But yeah, I'll pass over to Nathan and Cami. So yeah, thank you ever so much, guys. Over to you.
Morning, everyone. This is Cami Amira here. I'm apologising in advance. There's no subtitles here, but hopefully you'll all be able to understand me. The first part of the introduction I'm going to cover is really just to try and give you guys a feel for the size of the later life market, together with reasons as to why it has grown so much over recent years. And more importantly, to you as business writers, how it will continue to be a big opportunity for you all going forward. As you see on that slide there, we've been in the later life market for many, many years now at Family Building Society with some interesting USPs, and Nathan will cover a lot of that in his presentation in the second part of this. If we go to that slide there, it looks a little bit busy, but the shaded areas, what they actually show you is that between 2020 and 2030, the biggest population growth areas are going to be in the ages between 57 and 72, which is the top one shaded, and then the 75 to 87, the one below. And it's interesting to note that there's currently 20.9 million adults aged over 55 in the UK, and this is expected to grow by nearly 3 million by 2030, and many of these will have the need for a mortgage. This is quite a busy slide, but what it does show in the bottom section there, which is circled in red, is that by 2045, for those of you who may still be young enough to be working in the industry at that time, unlike myself, that the biggest area of growth is set to be for those who are of pensionable age, which again just indicates how more and more people are going to be living longer going forward. This graph here just shows the total volume of lending to borrowers aged 55 and over. And as you can see, the numbers have been growing quite steadily year on year, with the exception of the small dip in 2020. However, last year bounced back to be a new record level. Going on from that, as I say, the previous slides showed that COVID did have an initial negative impact on lending volumes to customers aged 55 and over. However, to repeat myself, the 2021 numbers bounced back to achieve a record lending level of 28.1 billion. The fact that 4 out of 5 mortgages for older borrowers are standard mortgages, it's an indication that many later life mortgages are now becoming more mainstream. The numbers at the bottom of this slide show the growth in 2021 from 2020, both in terms of numbers and volume. The house purchase numbers were 63,650 cases, which is up 46%. And that's a heck of a lot of cases, as you guys can see. The volume figure of 28.1 million, which I mentioned earlier, is an increase of nearly 22% from the previous year. This slide shows that the volume of lending by age of borrower is significantly higher in the top band. And that top band there is for people aged between 55 and 59. That's where most of the activity takes place. The numbers then drop in the next two categories before jumping up again at the ages 70 plus. This next slide shows the majority of mortgages when they mature, and the biggest number mature when borrowers are in the age between 65 and 74 age bracket. Now, this is beyond the historical age that many people in my parents' generation used to retire at, and it shows that mortgages are much more available and often required by customers to later ages in the present day. This next slide shows the RIO numbers. Now, RIOs were introduced by the FCA in March 2018, and the sales in RIO have been very, very poor. And I'm sure most of you will be aware of that. This is a particular bugbear of mine because it's an FCA requirement that the lowest earning applicant must be able to afford the mortgage in their own right at the time of application. And this is restricting the sales of RIO cases. And as I say, it's a particular bugbear of mine. It's the FCA who introduced it, wanted the RIO product there, but they are the ones that's put in the biggest restriction to selling this product. One consolation, however, is that many of these RIO cases, they do meet the underwriting requirements of other later life lending products and standard products. So we do sometimes find a home for some of these. Now, there are several factors as to why there's increased demand for later life mortgages. Some of them are on that screen there for you. From my personal perspective, the three big ones are the aging population, which we've covered already. And as I say, more and more people are living to longer ages and requiring mortgages. The other one is the number of maturing interest-only mortgages, which are a big part of this market, and I'll be touching on that later on. And then not forgetting, I'm sure most of you have come across the people who are using the bank of mum and dad and even the bank of granny and granda to get their family members onto the ladder. However, it's not all plain sailing for borrowers aged 55 plus. Many can find it a challenge to get a mortgage. Their age is often a restriction because the term offered by some lenders, and these vary from lender to lender, can actually mean that there are a limited number of lenders who can help them. There's also a lack of availability for older applicants, as many high street lenders do not have options available to the whole market, hence the reason that many building societies and specialist lenders are very active in this market and tend to dominate it more than the big six on the high street. There's some more stats here that show that we do have a growing population of older people. A couple of key points for you brokers, in my opinion. The first one is the fact that 1 in 5 mortgages are interest only, and many of these do not have a repayment vehicle. So on maturity, many who have high street lenders mortgages, the high street lenders will not offer them an extension, and this creates a big remortgage opportunity for you mortgage writers. Secondly, the mortgage debt for the over 65s, as you can see there, is due to nearly double from the 2017 number to 2030. And again, this will just create more opportunities in the market for you brokers. There's a staggering 900,000 interest-only mortgages out there in the market, which are due to mature in the coming years. And this is a huge number. And it just offers you guys out there a massive opportunity to capitalize upon. And the final slide for me, just to endorse some of what I've said already, and this slide is from information we received from Criteria Brain, and it shows that 2 of the top 5 searches they receive relate to maximum age at the end of the mortgage term. So as you can see, you brokers out there are sourcing this kind of thing on a regular basis. That's been short. Hopefully it's been sweet. Hopefully I've covered what I've covered, giving you an indication of how big the later life market is, and more importantly, how big it's going to be in the foreseeable future. And hopefully this will give you the opportunity to capitalize on some great opportunities to make sales. Thank you very much for that. And I'll pass you over to Nathan now.
Lovely. Thank you very much, Cammy. Some really interesting facts and figures there, and really does show how the later life market has certainly grown in recent years. Now, just as a little bit of introduction to us as the Family Building Society and how we can help. As we said, we've been lending in and into retirement for quite a long period of time now. Also, what you sometimes find with the later life clients is they may not necessarily pass a credit scoring basis. They may have a mortgage at the moment, but may not have a lot of other debts and other things like that in the background. So there are options that we can help there. And we have quite a flexible underwriting and individual approach to our lending decisions. We are a manual-based lender. We don't use a computer to tell us whether we should or shouldn't lend to your clients. So the main things in regards to the later life criteria that I want to focus on is the vast majority of cases that we do get, we see are from high street customers that they have had mortgages with them in the past in their mid to late 60s, coming to the end of the line with their existing lender. They go back to them thinking, oh, I've looked after my mortgage for a long period of time. They'll look after me. They'll provide me with another term extension. And unfortunately, more and more, they're finding the door is closed upon them and the debt's being called in. We offer a huge amount of flexibility with regards to lending into retirement with higher maximum ages than the majority of lenders out there. So for an owner-occupier case on a repayment basis, we're quite happy to consider your clients all the way up until the age of 95 at the end of the mortgage term. That's compared to maybe 70 or 75, even 80 in some flexible lenders' cases. That's an extra 15 years worth of borrowing potential that we can do, which might make the monthly payments a lot cheaper, especially in retirement. We are quite comfortable with taking owner-occupier interest-only mortgages as well. A lot of the high street have closed the doors on those or have put extremely difficult barriers in order to get those types of interest-only products. For us, we're still quite happy to consider those. And buy-to-let mortgages. More and more people are investing in property. We're happy to consider your client from a maximum age of 89 once the loan starts. Now, what we take into consideration for these types of cases is earned income typically up until the age of 70. We can stretch to age 75 for professionals. So your doctors, your people like that, accountants, anyone that's in a non-manual profession that's got a qualification behind them, have got sufficient experience behind them, we can consider those. Pension pots. Pension freedoms came in 2015. There's a huge amount that can be done with those, and they can access them a lot sooner. So if they have those in the background, we can consider those. Fixed pensions, whether they be some of the lucky few that still have final salary pensions, we can take those, or any guaranteed pension that they will get upon their retirement. You will also find there are a few customers that set up their own limited company. More and more people are doing buy-to-lets in SPVs as well, or they might have set up their business that's now being run by their sons, daughters, grandkids, and they are still shareholders within the business. As long as they're not actively involved in the day-to-day runnings of that, we can quite happily consider that income all the way to age 95 as well, and rental and investment income as well. So there's a multitude of different incomes that we are happy to consider, use all of it together to provide the client with the best solution and for them to keep that mortgage running forward. In regards to the criteria, we'll consider up to 80% in lending into later life. That's if we're looking at a repayment mortgage or even on interest only, if they have a repayment strategy already in place. So we do really high LTVs on those types of businesses. Parents in retirement can also assist their children's borrowing potential with a joint mortgage sole occupier. We're beginning to see a lot of these types of cases where the parents are looking as the bank of mum and dad. They may not have a huge amount of cash behind them in order to assist to provide them with a larger deposit. Or maybe there's a separation that's happening and they want to keep that property in their son or daughter's name, but they don't have the extra money to help pay them off. They can come onto the mortgage and assist with the affordability to keep that property within that family unit, maximising the potential borrowing all the way up to the age 95 for the parents. Re-own mortgages, we've touched on those. We do offer those products as well for applicants aged over 65. Once again, we're looking at the guaranteed incomes for those. But if we can't make it fit on a REO, then potentially we can maybe make it fit on a standard interest-only mortgage. All of our cases are manually underwritten. We can always talk through them up front, and everybody's circumstances are different. The main thing is we'll listen to each of your clients' individual stories, and we'll see what we can do on a case-by-case basis. To put into perspective some of the cases that we have recently done that shows the flexibility and shows the types of borrowing potential and types of clients that we are dealing with, I've got a couple of case studies here for you to have a look at. This one for Mr. and Mrs. A. They set up and run their successful business as a care home for over 20 years. They retired from that, and especially from the day-to-day runnings of that business, and that was then looked after by their children. They themselves were in their early 80s, and they currently had an outstanding interest-only mortgage that was coming to the end of its expiry. And they didn't really want to go down the equity release route because they could afford the monthly payments if they wanted to. And they wanted to make sure that the debt wasn't going to start running away with them. So what they wanted to look at was what kind of terms could they get on a standard high street lender. The clients were still the majority shareholders of the business, and they also had a receipt of state pension. However, they weren't drawing on any of those profits. Those profits were still sitting there in case they needed to. So actually, when you looked at the SA 302s and we looked at their pay slips, the only provable income that you had at that point in time was just the state pension. So what we were able to do is we were able to look at the client's share of net profit from the business, because as I said, there were still majority shareholders within it. We could get an accountant's reference to confirm that they weren't actively involved in the day-to-day runnings of the business. We could then also utilise the client's state pension and combine all of that income together in order to facilitate a £350,000 remortgage on an interest-only basis for another 9 years, so they could keep within their family home. So they didn't have to worry about what was happening for at least another 9 years. They had sufficient equity in that to facilitate a downsize later on if they needed to as well. And it gave them the peace of mind that actually they had plenty of time before they had to worry about that. The second one as well, we had Mr. G. He retired early. He didn't wait until 66 in order to retire. He managed to do very well and invested in some buy-to-let properties, and also invested in a SIP in the background, and began to actually enjoy his retirement slightly earlier on. His own main residence was unencumbered. He wanted to be able to give some equity to his son so that he could benefit from his assets rather than wait until he passed away and he was eventually going to inherit it. So what we could consider on that one is we could use the client's net profit from his buy-to-let portfolio, which we could evidence upon an SA 302. So that shows that income was regular, stable, and was going to be coming in. The client could effectively put his feet up, and that rent should be coming in on a monthly, annually basis for the foreseeable future. We could also look at his SIP. So even though he wasn't drawing it, he was over 55, so he was able to claim on it if he needed to. We used 80% of the value of that SIP, and we looked at that over the term of the mortgage. So what we did is we wanted a 10-year term for this client. He had over 500 grand sitting in his SIP. We did 80% of that, so that was £400,000. We divided that by 10, so that gave us a usable income of 40 grand on top of his buy-to-let rental income. So he was able to raise £200,000 that he could give to his son so that he could buy his dream home rather than starting at a starter flat. That was also the most important thing. The son could afford to buy a flat in his own right, but what he wanted to do was skip that first introductory step and try and get to the best possible house and best possible home he could at the very beginning, so he didn't have to worry about stamp duty costs later on down the line, estate agency costs later on down the line, what the mortgage market was doing and his own affordability was doing at that point in time. So it allowed him to jump that first starter home step as well to get him the best possible home to begin with. That gives you a bit of an overview of the types of cases that we are interested in and the types of things we can do in regards to later life. If you've got anything that you want to talk through, give us a call. You've got 6 BDMs there that cover the majority of the UK, and we've got a fantastic new business team at our head office that are always willing and happy to help. Thank you very much. And have we got any questions?
Brilliant. Thank you ever so much to both of you. Lots of useful information there. So we've got lots of questions coming through. So I'm just going to fire them at you, and then you two can decide between you who answer them. So we've got someone here who's got a client who has no private pension, only state pension, but they do own 5 buy-to-lets. What income could the broker advisor use to support the application, and could this be on interest only?
Okay, I'll grab that one. So yes, we can use the state pension on that one. I think you mentioned there was buy-to-lets in the background as well. So as long as that income is being declared on an SA 302, we can use all of that income that's available to them. With that is, if you look at the SA 302s, there's been a few changes recently. If there are mortgages on the property, then we would need to take off the non-deductible finance costs. So when you look at the SA 302, 5 or 6 lines further down, it normally gives you a figure that is times 20%. So we would have to take the gross figure off the top right-hand corner, minus that figure further down, and that will give us the net usable income that we can do. And then we can use all of that income to support the mortgage. Yes, it can be on interest only. We can consider up to 80% on interest only for that as well, because we could look at using the buy-to-let portfolio as the exit and the repayment strategy for that loan as well. So we can do quite a lot for that client. Yes.
Perfect. I have a client whose daughter is going through a messy separation and they want to help facilitate a remortgage to pay off the ex-partner. How would you be able to help with this?
Okay, I'll jump on that one again. So with that, the options we have are a couple of fold, really. They can come on as a joint borrower sole proprietor. Depending on their ages and the incomes that we're looking at using, we can either take it to age 70 or age 95 if we're using retirement income. And they can come on as a joint borrower sole proprietor up to 80% in order to raise the capital to pay off the ex-partner. So they can do that way as one option. Another option, if they don't want to be on that mortgage, they could always do a remortgage on their own property to free out the equity, like we did on the previous slide and the final case study, where they can raise 50, 100 grand, whatever they want to provide them with a gift, so that then their clients' children can then do their own remortgage on their own property, and the additional monies come from the parents and do it that way.
Brilliant. Just going back to the first question I asked with the buy-to-let income, David has asked, would you accept a bank statement rather than an SA302 showing the rental income?
No, so in order for us to use it, it does need to be evidence on an SA302. So they'll need to have had it running for at least a year, so we can evidence that the income is coming in, and also more importantly, being declared and paid tax on.
Cool. Another one here. So client is a first-time buyer with a right to buy, is 64 years old, works as a bus driver until 75, but wants to look at a 20-year term.
Okay, so as a bus driver, we'll take the income up until the age of 70 for someone like that. If they've got sufficient pension in the background that we could utilise, so say they paid into their own employer's pension scheme, and they can provide us with a statement of how much that's going to be worth later on. When they do retire, then obviously we can look to extend the term up to age 95, basing the affordability on the pension income later on.
Cool. This is a good question. So what is the family looking at in terms of new innovative products coming out down the line? Any unique criteria, tweaks, any kind of exclusives we can get today?
Cammy, do you want to jump in a little bit on that side of things?
It's a great question, but it's very, very early in my tenure. I just rejoined the society on the 1st of February. So I've been in here 4 weeks, and I'm doing 3 days a week. But I have written a paper highlighting 1 or 2 areas, both in terms of criteria and in terms of products that I think we could look at. I think in terms of products, I think it'd be unfair at the present time to suggest things that we might be looking at in case it doesn't come to fruition. But I think as well as product, I think criteria is very important, and I think that we've got a lot of gaps in our criteria, particularly in the amount we lend at certain loan to values. So one of the things I will be pushing is for us to be more competitive in terms of how much we lend at 80% loan to value, for example. And also I think our affordability calculator is a bit stricter than 1 or 2 other lenders in the market. So we're pushing for things like that. I've also noticed that one of our offerings on contractors can be a bit restrictive in terms of the minimum income we require from them. So there are quite a lot of things that I will be suggesting, and as I say, it's part of my new role there. But it's just a little bit early for me to actually come along and give any positivity about it, albeit the society have got massive plans to grow from where we are now. We want to almost double our lending over the next 5 years, and that's a key part of what I'll be trying to do with them in terms of looking at that. So we're not going to be able to double our lending without coming up with some stuff. So although I can't give you anything at the present time, all I can say is watch this space, because we'll have to do something to become more competitive. And I do have an initial meeting later on this month with the head of lending, the chief exec, and a couple of other execs to discuss my initial findings. So hopefully there'll be some good news coming to the market quite soon.
Cool, brilliant, very exciting. Another one here. So do you expect the rising cost of living to lead to a rise in later life lending?
I mean, I would say in regards to what we're seeing in the marketplace, we are finding that for a lot of clients is they are trying to make sure that they can maintain their mortgage payments, have a good quality of life. So we're beginning to find that more and more people are probably looking to, rather than do what they used to of, I want to pay my mortgage off as soon as possible. I want to get that debt gone. I want to be debt free. They're actually thinking a little bit more of the here and now of, I'd rather have a better quality of life now. And that normally ends in, let's extend the term. Let's have a slightly longer mortgage term rather than it being a 10-year. Let's do a 15-year, or let's do a 25-year, or maybe we could do it on interest only instead of on a repayment basis. So I think all of these factors combined together will probably drive a increase in later life lending as people are beginning to continue the debt, and also where they're planning later in life to for inheritance tax planning and things like that, to keeping debts on the properties, they're beginning to try and extend it further out as well. So I do think all of those types of things will have a impact in driving that forward and increasing it later on.
Brilliant. Question from Jim: do you lend in Northern Ireland?
No, so we're England and Wales.
Cool. So question from Natalie. What if the client only has state pension? I have a client who's on interest only and not working because she is housewife and has no other pension.
Okay, so we can use that pension there. In regards to what options that they have, ultimately depends on the circumstance of what they've got in the background. So if they're a housewife, then if the property is just in their name, I don't know if they are cohabiting with someone who has a larger income. If the property is already in one name only, then we could always look at a joint sole proprietor for them. So we could do it that way with the person who they're cohabiting with, or if they've got children, they can jump on the mortgage as well and assist that way. And we can possibly look at keeping it on an interest-only basis, or maybe switching it to a repayment so that over the next 10, 15, 20 years, they might be able to pay that mortgage down and get that debt gone.
Brilliant. Someone else here has a client who is 75 and would like to invest in a buy-to-let to top up their pension income. Is this something you could assist with?
Yes, certainly. It's certainly something that we can look to do. We get it on quite a regular basis. We don't have a limit in regards to the age for first-time landlords. So we're quite comfortable taking those older customers for buy-to-lets. Obviously, when they get a little bit older, we're more inclined for them to have a letting agent in place. We don't necessarily think it's the right thing for a 75, 80-year-old to enter into the buy-to-let market straight away and try and manage it all themselves. So we would be insisting that there would be a letting agent in place for something like that. But yes, it is certainly something that we can do.
Cool. Question from David: are there different occupations you will take into account to go past 70 without evidence of pension income?
Yes, so there's a variety of different jobs that we can consider. Typically, we're looking at professionals in relatively non-manual occupations. So doctors, nurses, lecturers, teachers, those types of clients, accountants, mortgage advisors. The one thing I'd suggest to that is we can on cases take it on a case-by-case basis. So it depends on their role and their experience and what they're physically doing. And we can take on a view on it depending on the circumstances. So what I'd always recommend, give your BDM a call. If you don't have a BDM in your area, so when you look on the intermediary website and put your postcode in, if it gives you the head office telephone number, by all means give them a call. But I don't mind taking phone calls from anybody in anywhere. So by all means give me a shout and I can talk it through with you.
Lovely. My client is coming to the end of their term on an interest-only mortgage with another lender. They are 66 and 67 and are both retired. Would you like to pay the mortgage off, and what term could you offer? Oh, sorry, they would like to pay the mortgage off. What term could you offer? My poor grammatic there.
No, not a problem at all. So with that is that we can consider up to a 28-year mortgage term for that client based on pension incomes if they want to pay it off that way, or they can do it on an interest-only basis with overpayments on a 10% as a maximum that we can do on an annual basis as well. So they can look at doing it that way. So either or, we can consider quite long terms on a multitude of different ways to facilitate it, depending on what they want to do. The other options that we have is if it doesn't quite fit or they don't quite want to be paying as higher mortgage payments on a full repayment basis, we can always consider a part and part. So we could do part on interest only, part on repayment, so that keeps the monthly payments down to a comfortable level, depending on what their circumstances are in the affordability limits.
Brilliant. This is a great question, which I'm sure being a BDM you're used to get asking. What do the family do that no other lenders do?
Personally, I think what we do that no one else does is we really do take the time to discuss the case fully with you. I know myself, I will quite happily go through the full case details. I can check credit files for you. I can run through a set of accounts for clients. I can speak to the underwriters directly. Every single underwriter we have direct lines to. It's not just me calling up the telephone number and finding out what we may or may not do. So we will go above and beyond to assist you with your case and assist you from start to finish. Outside of that, in regards to what others don't look at doing, we can consider a multitude of different incomes. We can also consider expats. We can also consider interest only. We can consider a multitude of different things, and that the high street won't.
Perfect. Brilliant. We've got a question about buy-to-let. Do you lend to non-owner occupier for a buy-to-let?
Depends on their circumstances. So typically we will always prefer them to be an owner occupier. However, there's a multitude of different reasons why that may not necessarily be the case. They might live in a property that's owned by their husband, wife, that they reside in, and that's always been in one name, and they want to invest their own money onto a buy-to-let. So that's perfectly fine. They also might have a portfolio of properties. They might have 10, 15, 20 already in the background and they just want to add to it. Those types of things we can look to consider. With all these types of cases, the main things we're always concerned about is what is the risk of that person moving into said property. So sometimes location can come down to it. They might be living down in London. They want to invest further up north or vice versa. And they work, live, and have always lived where they currently are. And we can look at those on a case-by-case basis. Yes.
Cool. Question here from Kevin, which is a question we get a lot actually on our live chat at Criteria Brain. So with about looking at self-employed individuals that are not in professional roles. So for example, you've got someone that's a taxi driver but isn't intending to retire. How long can you use that self-employed income till?
So typically we'll look at using that until 70. In those types of roles. Once again, it does depend on the type of role. If it's a manual job where they're having to do quite a bits and pieces, they're driving, things like that, we understand that clients are working later on and they are wanting to work. But that as far as we were looking, that's more of a lifestyle choice. And if they want to continue to do that, that's fine. The most important thing we need to be looking at as a responsible lender is it reasonable for us to assume that maybe a 75, 80-year-old is going to continue to be driving around as a taxi cab all that time? They might be, but they might be taking a lower amount of income, or they might only be doing it 1 day a week instead of the 5 days a week. So we have to be pragmatic in what we're looking at. What we also do sometimes find, and this is worth mentioning, and it's always worth the broker grabbing hold of a set of the company accounts for clients like this. What you do sometimes find is they try to squirrel away as much money as they can. So they might be putting significant money into pensions and things as well. So what we can look at, especially on the early stage of things, if they're investing into their pensions and they're taking it out so they're not paying the tax on it, we can look to potentially add that back in for their income now. So if they've got a net profit of £20,000, but actually they put 10 grand of that into their pension fund recently, if they want to have a term that goes to age 70, instead of 20,000, that could actually be 30,000. So once again, we can look at the individual circumstances and maybe see if there's a way that we can factor that all in to enhance the borrowing earlier on.
Cool. I think you have mentioned this, but I'm just going to, because I've got a question just to double check. Do you guys offer joint owner sole proprietor?
Yes. So joint borrower sole proprietor or joint mortgage sole occupier, there's a couple of different acronyms for the same type of thing. Yes, we do offer it. It is for parents and children only. And obviously the term will be factored in depending on the oldest applicant. So parents can assist children, children can assist parents. We will allow up to a maximum of 2 people to assist. So if you've got an owner occupier in the property and they live there, then mum and dad can help, or the son and daughter can help. We won't be able to allow is one person living in the property with 3 people assisting. That's pushing it a little bit too far for it.
Cool. Jumping back to buy-to-let, do you guys do regulated buy-to-let?
We don't do regulated buy-to-let where the family members are going to be residing in it. One option that we are quite comfortable with doing as a second option, or at least something to consider, is if there's no official AST in place and the sons or daughters, for example, may have the property for their mums or dads or vice versa to live in, we can consider a standard interest-only mortgage as like a second home basis on an affordability basis, so like a normal interest only. So we've got one recently where dad owned the property that the son was living in. Son had a small part-time job, wasn't paying full rent, there wasn't an official AST in place. We did a pound for pound interest only remortgage on that property the son was living in based on dad's earned income.
Cool, brilliant. Oh, there's plenty of questions here. I'm keeping you on your toes.
Yes,
We've got someone here. It's asked how kind of what the family do with looking at older clients being classed as vulnerable clients. So I don't know if you've got any sort of comments or feedback on
that. In regards to vulnerable clients, it depends on what they mean by that. So one thing that we are very good at is we will always take client circumstances into consideration. We've got in the background, we've got a portfolio manager that looks after our older clients, our older debts, some of the old like equity release mortgages that we have in place. And they regularly keep in touch with them, see how they're getting on, if there's anything that we can do to assist and vice versa. So it depends on what the meaning of the vulnerable clients is. One thing I'll kind of touch on slightly is actually we're getting more and more inquiries for mortgage prisoners. So you're getting customers that can demonstrate a higher mortgage borrowing, maintaining a monthly payment for the higher mortgage borrowing, and actually the affordability limits, because of the regulation that's in place, is becoming quite restrictive. So we had one just as a live case that we were talking through yesterday, where actually when you put it through the affordability calculator, it was coming up at about £112,000. But they were currently servicing a mortgage of about 133, and they were currently with their existing lender on an SVR of about 4.85%, something like that. So their mortgage payment was really quite high. And actually what it meant to them by refinancing and remortgaging to us, the interest rate was significantly lower. Their monthly payment was nearly half, and actually putting them in a better financial position that they could show that they could demonstrate they've maintained higher mortgage payments. And we actually considered that case as an exception to policy, because they could show that they had maintained £600 a month instead of the £300 a month they were going to be coming to us. So we looked at that on a 10-year interest only, and because it was the right thing to do. So they were vulnerable in the fact of, well, they only had one option, which was either go remortgage or get out. And we said, well, let's see if we can keep you in that property for another 10 years.
Brilliant. Just jumping back, Hazel, here is a question on where you're talking about joint borrower, sole occupier, proprietor. Does the parent have to have their own mortgage? Would it be okay if the parent's property is unencumbered?
That's perfectly fine. No reason why we won't consider that. In fact, you would probably expect the majority of the of parents and older clients probably not to have a mortgage on their home. So the fact they haven't got one, that just shows that they've done the right thing and they own their own home. So that's perfectly fine. The only thing that we can't do on a joint borrower sole proprietor is we can't do it if the parents are in rented. So they have to be an owner occupier.
Cool. What is your initial term fixed rate periods?
Sorry, repeat that.
What is your initial term, and just sort of some information around sort of fixed rate periods you have as well?
Okay, so it depends on the case. So we start off, like with most lenders, on 2-year fixed rates. You may not find many of those on the website, because recently they were withdrawn due to the lovely rate rises that have been happening in the Bank of England and bits and pieces in the background. But they are due to be relaunched as of tomorrow. So as of tomorrow, you'll start seeing 2-year fixed rates starting back on the intermediary website. Our minimum term is 5 years and our maximum term is 40.
Cool. James has got a question here. Do you offer let to buy mortgages? Client is looking to release equity to buy an onward residential and renting out the current resi. What is your highest loan to value you can do? And do you have a maximum figure they can release?
So maximum figure they can release ultimately boils down to the loan to value. So if you look on the intermediary website, you've got LTV and loan criteria on there, and depending on how much they want to free out will ultimately dictate the maximum that they can have. As it's a let to buy, our maximum loan to value will cap out at 70%. but there's no problem with what they're looking at doing at all. That's perfectly fine.
Cool. And everyone here, would you accept a remortgage of a buy-to-let? Married couple are separating, and Mrs. Is looking to maintain the current residential, and Mr. take ownership of the current buy-to-let as he has his own residence.
So we're looking at doing a remortgage and a transfer of equity into one name out of two.
Yep. So remortgage of a buy-to-let to a residential, and then take one ownership.
Yep, that could be looking at something that we can do as long as we get confirmation from the solicitors that the tenant obviously is going to be vacating and they're going to be moving in to live in it upon completion.
Cool. And this is a good one. Do you expect or think we need more funders for later life lending entering the market?
Cammy, do you want to jump in there?
Yeah. Hopefully not, because there's less competition for us. But realistically, I think it's a well-serviced industry at the moment. I think there's many lenders in there. The vast majority of building societies, and there's about 47, 48 building societies. The vast majority of them will do later life lending. The specialist lenders is in there as well. I don't anticipate a large number of new lenders who come to market to actually target later life. Most of the new lenders seem to target buy-to-let because obviously the margins are a lot better for them in that. So I think it's a well-serviced industry. I'm not saying nobody else would come into it, but I'm not anticipating many new lenders who are signed off by the FCA to become a first charge lender that they will target the later life lending market first. I think they'll come in at buy-to-let and other higher margin products first.
Brilliant. The presentation as well you presented today with the slides and that one, is it possible for advisors to have a copy of that afterwards? Would they contact you to arrange a copy of that?
By all means, if they want to give me a call or drop me an email, then I'll see what we can get out.
Cool, brilliant. Let's got one more question here. On joint borrower sole proprietor, if we are not using the income of the parents for affordability, would you still go by the oldest applicant's age, or would you use the age of the applicant whose income you're taking into consideration? Example, children helping the parents remain in the property on joint borrower sole proprietor.
Yeah, so we would typically look at, on the majority of cases, there's a certain limit as to how far we can go in regards to our age limits on a regulated mortgage and what we are comfortable at doing. So we would need to consider the age of the older customers, but we can go to age 95. So normally it would end up being really quite older later in life before we could stop offering them good terms. So if they're in their early 70s, we can still do 25, 26 years. So we can look to consider those types of cases. Worst case, if necessary, and it doesn't quite fit, or the monthly payments become a little bit too high or a little bit more onerous than they may necessarily want. Once again, we can always look at considering maybe we might be able to do a part and part and see if there's something that we can assist with on there on an interest-only basis.
Brilliant. Thank you ever so much. So I'm going to draw it to a close there. We will get all the questions over to Nathan and Cammy. So if there's anything we've missed, then they can get back to you with a response. I really hope you found today's session interesting. It's given you some good practical direction and food for thought. If you're watching this event live, then as I mentioned earlier, we'll be in touch to get some feedback. So thank you in advance for sharing your opinions on that one. We'll upload the video so you can come back for the next 30 days to watch the masterclass. But thank you ever so much to Nathan and Cammy for your brilliant presentation and staying around to answer some questions. We'll be in touch soon and adding details to Criteria Brain for the next masterclass that will be coming to you. So thank you very much, everyone. Thank you.